You open a letter from the IRS. It says you owe $50,000. Your stomach drops. You start thinking, how am I going to pay this? Am I going to lose my house? Are they going to take my bank account? But before you start figuring out how to pay the IRS, there's one important question. How do you know they're right? I'm James Duff with Duff CPA Tax Resolution, and today I'm going to tell you something that surprises many taxpayers. IRS bills are not always correct. Most folks assume that if the IRS says they owe $50,000, then they must owe $50,000. Not necessarily. The IRS has a tremendous amount of information, be 1099s, brokerage statements, retirement distributions, mortgage information, but the IRS doesn't always have the full story. Sometimes they're missing information. Sometimes they're working from incomplete records. And sometimes they're basing a balance on assumptions that turn out to be wrong. One of the biggest reasons that an IRS balance becomes inflated is something called substitute for return. Most taxpayers have never heard of it. Let's say you don't file a tax return. The IRS may eventually prepare one for you. Sounds so helpful, right? Well, not exactly. Because the IRS generally prepares that return using the information it has available. Income, interest, dividends, retirement withdrawals. But what might be missing? Business expenses, rental deductions, stock basis, dependents, credits, itemized deductions. In other words, the IRS may calculate the tax using information that increases your tax bill without the information that could bring it down. I've seen taxpayers who thought they owed enormous amounts because the IRS prepared a substitute for return. After proper returns were filed, the balance dropped significantly. Sometimes the IRS receives information, maybe income was duplicated, maybe brokerage statements were misunderstood, maybe a taxpayer inherited it in an account and the reporting was incomplete. The IRS isn't intentionally trying to overstate your balance, but they're only as good as the information they're receiving. Here's why taxpayers get themselves into trouble. They receive a huge IRS bill, they panic, they immediately start thinking about borrowing money, cashing out retirement accounts, maybe selling investments, taking a home equity loan before they've even confirmed the balance is correct. That's backwards. The first question is not, how do I pay this? The first question is, do I actually owe this? I've had taxpayers call my office convinced that they owe tens of thousands of dollars. They have already accepted it as fact. They were preparing to drain savings. In some cases, after reviewing transcripts and records, we discovered the situation wasn't as bad as they thought at all. The balance wasn't necessarily zero, but it wasn't what the IRS initially claimed either. And that's why verification matters. If the IRS says you owe $50,000, don't ignore it, but don't blindly assume it's correct either. Get the facts, review the notices, review the transcripts, review the missing returns, review the supporting documents. The goal is simple, determining what you actually owe, not what you're afraid you owe. And here's the one big thing I want you to remember. An IRS bill is a starting point for investigation. Not necessarily the final answer. Sometimes the IRS is exactly right. Sometimes they're not. But you'll never know until someone looks at the details. If you've received an IRS notice claiming you owe a large balance, don't panic and don't automatically assume the number is correct. At Duff CPA Tax Resolution, you'll work directly with a CPA or an EA who can review your IRS records, explain what's happening, and determine whether the balance is accurate. No salespeople, no call centers. Just experienced tax professionals. I'm James Duff. Call us today at 203-589-4077 or visit us on the web at www.dufftaxresolution.com. I'm James Duff, and in the next video, we're going to answer another question that taxpayers ask all the time. The IRS filed a return for me. Am I screwed?